Welcome to The Explainer. Today, we're diving into something super fascinating, the evolution of corporate taxation in Nigeria. We're going to look at how tax laws are designed to handle, well, everything, from specialized businesses planted firmly in the ground, all the way up to the invisible, rapidly expanding digital frontier. Seriously, it's a wild story of how traditional rules are just being stretched to their absolute limits by modern technology, and how authorities are hustling to keep up. Here's our roadmap for today. First, taxation beyond the standard. Second, incentives and tax breaks. Third, taxing physical cross-border trade. Fourth, the e-commerce tax problem. And finally, number 5, solving the digital puzzle. So, I want you to keep this question in the back of your mind as we go. How exactly do you tax a company you can't see? I know, it sounds like a riddle, right? But it's actually the ultimate challenge of modern global economics. And by the end of this explainer, we'll uncover exactly how governments are attempting to answer it. Section 1. Taxation beyond the standard. Moving beyond the standard corporate tax code. You know, not every business operates the exact same way. That means a one-size-fits-all tax rule, it just doesn't work. Think about a standard retail shop. Figuring out its profit is pretty straightforward, but the Nigerian tax code actually has to adapt to govern highly specialized industries. Think about an agricultural plantation, or a massive telecom network, or a business operating entirely inside a free trade zone. These sectors have completely different day-to-day realities, huge capital requirements, and real strategic importance to the whole country. Because of all that, they demand unique tax computations and very specific legislative rules. Okay, let's dive into this next part, Section 2. Incentives and tax breaks, cultivating physical, domestic growth. Look at the sheer scale of this incentive, a full 100% tax exemption. That is huge. The government really wants to encourage the manufacturing of goods for export, to diversify the economy and create jobs. So if a company sets up shop in an approved export processing zone or a free trade zone in Nigeria, and their business is 100% export-oriented, they pay zero tax on their profits. None. It's a massive structural advantage, and it's totally designed to make Nigerian exports highly competitive on the global stage. This next part brilliantly illustrates how the government protects and cultivates the domestic economy, especially in agriculture. Just look at these targeted tax breaks. Small and medium-sized companies can get what's called pioneer status. That gives them an initial tax holiday of 4 years, which can even be extended by 2 more. Plus, import duties on tractors slashed from 35% all the way down to just 5%. Banks are even pushed to give tax-exempt loans to these businesses as long as there's a 12-month grace period. But, and this is a big but, notice that final point. This is strictly for primary agricultural production. We're talking about growing raw crops or raising live animals. The very second you start intermediate processing, like turning those crops into packaged goods, those specific primary incentives vanish. Moving on to Section 3. Taxing physical cross-border trade. When commerce takes to the sky and sea. So what happens when commerce physically crosses international borders? Just imagine a massive foreign airline, or maybe a global shipping conglomerate, trying to calculate their total global profit and then isolate Nigeria's exact slice, using all this complex global math. Honestly, it'd be an administrative nightmare. So the tax code just simplifies the whole thing. Foreign transport businesses are taxed based specifically on the income they make from loading passengers, mail, livestock, or goods right there in Nigeria. If an aircraft lands, loads up cargo, and takes off, the revenue from that specific loading is what gets taxed. No need to get tangled up in their massive worldwide operations. What's really interesting about this slide is how the tax code isn't just about throwing money into a general revenue pot. It actually directly funds national infrastructure through these specialized businesses. As you can see, there's a 1% levy on profit before tax for telecom and banks, and that goes to the National Information Technology Development Agency, or NITDA. Then there's a 0.005% levy on net profits that funds the Police Trust Fund. And for companies in sectors like aviation and ICT that pull in a turnover above 100 million naira, they pay a 0.25% levy for the National Agency for Science and Engineering Infrastructure. It's a super targeted approach to paying for infrastructure. All right, let's get into the real conflict here. Section 4, the e-commerce tax problem, transcending borders into the cloud. When physical goods just vanish, companies transcend physical borders, and commerce moves entirely into the cloud. Traditional tax laws completely break down. And to understand why the system breaks, we first have to understand this critical legal concept, permanent establishment. You see, traditionally, a foreign company gets taxed based on having a fixed place of business, We're talking a physical office, a branch, a factory. Think of a standard brick-and-mortar bookstore. It's easy to see, it's easy to locate, and it's definitely easy to tax. But compare that to an ebook, downloaded by a user in Lagos from a server chilling in the Cayman Islands, sold by a company registered in the UK. Where exactly is the fixed place of business there? The whole concept just completely fails online. Let's contrast these two realms directly. The Nigerian tax system, and honestly, almost every global tax system, was built for traditional commerce. A fixed base, tangible goods you can actually touch, and clear jurisdiction. E-commerce is the exact opposite. Boundless geography, intangible digital goods, and parties that are often completely anonymous. When your entire tax system requires a physical presence to trigger a tax bill, the internet becomes a massive problem for revenue generation, simply because it makes international borders inconsequential. So tax authorities face three major practical hurdles in this digital space. First up, establishing identity. Websites can be virtually untraceable with owners completely hidden. Second, establishing location. An internet domain name tells you absolutely nothing about where the actual server or the business owner physically resides. And third, obtaining proof. Encrypted digital data makes standard documentation and auditing practically impossible. Just think about it. How can a tax authority enforce a value-added tax, or VAT, on a digital transaction when they can't even identify the anonymous buyer and seller, let alone physically intercept the product? The source material puts it perfectly. It says, the internet has made international borders inconsequential for e-commerce, leaving countries with the challenge of developing a workable tax policy. That really hits the nail on the head. This isn't just a Nigerian issue. It's a global technological crisis that is vastly outpacing traditional tax law. It's literally leaving billions of dollars of taxable revenue just floating, untethered in cyberspace. So the crucial point is, how do we fix this? Section 5, solving the digital puzzle, reclaiming the lost tax base. How do governments and international bodies fight back to reclaim this lost revenue? Well, one proposed solution is the refundable withholding approach. It's pretty clever. Instead of trying to chase down these invisible digital companies after the fact, the source country, let's say Nigeria, requires local banks or payment processors to automatically apply a standard withholding tax to all electronic payments going to non-residents. Bam, revenue captured safely up front. Then, for step 2, the burden actually shifts to the foreign company. If they want some of that money back, they have to reveal themselves, prove their identity, and file a formal tax return in the source country. Finally, in step 3, the tax authority calculates their true, exact legal tax liability and simply refunds any excess money that was withheld. It's a brilliant flip of the traditional script, right? There's also another alternative highlighted in our source material called the base erosion approach. This one tackles the problem from the buyer side. It essentially suggests applying a single rate of withholding tax on any payment that ultimately decreases the domestic buyer's taxable profits. Think about it like this. If a Nigerian company buys some really expensive foreign software, they're going to deduct that cost as a business expense, right? Which shrinks their taxable profit. The base erosion approach ensures that because that payment eroded the local tax base, a withholding tax is applied right at the point of that digital transaction. This protects the country's revenue, completely regardless of where that software company is physically sitting. So we've seen how taxation works when you can physically touch the goods, and we've seen the monumental struggle to adapt when you can't. I want to leave you with a final thought to chew on. In a truly borderless digital world where servers ping across continents in mere milliseconds, will these adapted traditional concepts of taxation even survive? Or is a unified global tax system eventually inevitable? Thanks so much for joining me on this explainer. Keep learning, keep questioning, and I'll catch you next time.